Equity. It's a term that's used a lot. Use your equity. Build your equity. But what is it? Whether you are talking about equity in a business or equity in a house, it's essentially the same thing. For a business, equity can be found on the balance sheet, which is one of the three main financial statements. You can think of equity in two ways. The first is that equity is the funds invested by its owners. On the balance sheet, you have three main items: assets, liabilities, and equity. Assets are the things the company owns. The company must pay for these assets somehow. It has two options. It can use liabilities, which is another way of saying it could borrow money, such as borrowing money from a bank, or it can use money provided by its owners or shareholders. This is called equity. The equation, assets equal liabilities plus equity, might help you think about it. Let's say you run a cafe. You are the owner and only shareholder. You want to buy a new coffee machine for $3,000. The coffee machine is an asset. To pay for the coffee machine, you borrow $2,000 from your brother and put up $1,000 yourself. The liabilities would be $2,000 and your equity would be $1,000. The asset, worth $3,000, is equal to the liability, worth $2,000, plus the equity, worth $1,000. It's very similar for buying a house. Say you wanted to buy a house for $300,000. The house is an asset. You borrowed $200,000 from the bank, that's a liability, and you put up $100,000 of your own money. That's equity. The second way to think about equity is that it is the money the owners can take out. The equation, equity equals assets minus liabilities, might be helpful. Say you decide to sell your coffee machine, and let's assume you get the full price back of $3,000. How much equity would you get back? Well, you can sell the coffee machine for $3,000, pay back your brother $2,000, and keep the $1,000 difference. The $1,000 difference is your equity. It's the same for the house. You could sell the asset, the house, for $300,000, pay back the liabilities, the loan from the bank, that's $200,000, and keep the difference, $100,000, which is the equity. Now that we have defined equity, let's see what types of equity we can find on the balance sheet. Equity comes in a variety of forms. Here are the most common. Share capital. This is sometimes called capital stock, common stock, or paid-in capital. This is what investors have paid for the common shares at par value. Par value is the face value of a share as stated in the company's corporate charter. Its value is often unrelated to the value of the company's shares. It will usually be a very low number, like 1 cent or 0.1 of 1 cent. It's usually just used to keep track of stock splits and consolidations. Additional paid-in capital, sometimes called capital more than stated value, is the amount investors have paid for common shares above par value. This will be a better reflection of what investors have paid for the company's shares. Let's say a company wants to raise $10,000 by issuing 1,000 shares at $10 a share. Let's also assume the company shares have a par value of $1. If you add up all the share capital and additional paid-in capital, you get the total amount that shareholders have contributed in equity. On the company's balance sheet, next to share capital, it will have a value of $1,000. 1,000 shares at a par value of $1 equals $1,000. Next to additional paid-in capital, it will have a value of $9,000. That is the difference between the price paid per share and the par value per share. Investors paid $10 per share. $1 of that was par value, which leaves $9 as additional paid-in capital. 1,000 shares were issued, times 9 equals $9,000. Retained earnings is the sum of all the net profits that the company has earned minus any returned equity to shareholders. If a company has retained earnings, this is a good thing. It means the company is turning a profit. When a company makes a profit, it can do three things with it. It can pay out the profit to shareholders via a dividend, it can buy back some of its shares from shareholders, or it can keep the profits. Paying a dividend and buying back shares are ways of returning equity to shareholders. Let's say a company generated $1,000 in net profit last year. If they decide to keep all those profits and not pay a dividend, then the net profit will move from the income statement to the balance sheet where it will be recorded as retained earnings. This is equity because it is money that is owed to the shareholders. A company will often choose to retain earnings so they can use them to grow the business. Let's assume another company generated $1,000 in net profit last year, but this company decides to pay out $100 to the shareholders in the form of a dividend. This company will record $900 as retained earnings. $1,000 in net profit minus $100 paid out as dividends equals $900 in retained earnings. Another way a company can return capital to shareholders is by buying back shares. Let's say a company generated $1,000 in profit last year. The company wants to buy back some of its shares from shareholders. Why would a company buy back its shares? A company will buy back its shares because it reduces the number of shares outstanding. By doing this, it means the shareholders who still have shares own a bigger piece of the pie. Let's say there are 1,000 shares outstanding. Before the company bought back its shares, the company generated $1,000 in net profit. That means the net profit, or earnings per share, was $1. $1,000 divided by 1,000 shares equals $1. Now let's assume the company buys back 100 shares. Now there's 900 shares outstanding. Let's assume the company makes another $1,000 in profit this year. Now instead of generating $1 in earnings per share, the company generates $1.11 in earnings per share. $1,000 divided by 900 shares equals $1.11. If you own one share, you would be getting an extra 11 cents in earnings. When the company buys back stock, you are left with a bigger piece of the company. Sometimes shares are bought but kept for possible reissue. This is called treasury stock. Treasury stock shows you how much the company spent to buy back those shares. This number will be negative. Why is it negative? It's negative because when the company buys back shares, it is taking equity and returning it to shareholders. By doing so, it will reduce the shareholder equity. Let's assume the company bought back 100 shares at $5 per share. The number next to treasury stock will be negative $500. Another type of equity that is far less common is preferred stock. Preferred stock has characteristics of debt and equity. Preferred stock entitles the holder to a fixed dividend. Preferred stockholders will be paid their dividend before common shareholders, but preferred stockholders don't get to enjoy the benefit of the stock's value going up. Preferred stockholders don't have voting rights like common stockholders. The value next to preferred stock on the balance sheet will show you how much equity has been contributed when the company sold preferred shares. If we add up all the items listed under shareholder equity, we get the total shareholder equity. Let's take a look at Nike's balance sheet. Here we have Nike's balance sheet from 31 of May 2023. Here we have the shareholders' equity. The first item is common stock at stated value. This is essentially common stock at par value. Nike has two types of common stock, Class A and Class B. Class A shares usually have more voting rights than Class B shares. Class A shares are usually created so that the founders can keep control of the company. Nike's Class A shares give the holders the ability to elect 9 of the 12 members of Nike's board. Holders of Class B shares elect the other 3. As of 31 of May 2023, Phil Knight and his family own 77% of Nike's Class A shares, so they have the power to elect 9 of the 12 board members. The figure next to Class A convertible is 0, so no equity was provided for the Class A shares. Next we have Class B. We can see $3 million was contributed as common stock at stated value. Next, we have capital in excess of stated value. This is the amount of equity provided for the common shares above the stated value. Shareholders have contributed $12.4 billion in equity. Next, we have accumulated other comprehensive income. Other comprehensive income are revenues, expenses, gains, and losses that are excluded from net income on the income statement. It includes things such as gains or losses on investments available for sale, gains or losses on derivatives held as cash flow hedges, foreign currency exchange gains or losses, and pension plan gains or losses. The figure we see shows the amount of other comprehensive income that is accumulated over time. Lastly, we have retained earnings. We can see Nike had retained earnings of $1.358 billion. We can see this number has decreased since 31 of May 2022, when it was $3.476 billion. Why is that? To see why, we can look at another financial statement, the consolidated statement of shareholder equity. Here we can see what impacted Nike's retained earnings. We can see Nike spent $5.13 billion repurchasing stock. They spent $2.059 billion paying dividends. They then generated $2 million from issuance of shares to employees and another $5.07 billion from net income. Add these all up and you get $2.118 billion, which is the amount that Nike's retained earnings decreased. So we know Nike has bought back shares. Why doesn't it show any treasury stock? When a company buys back stock, it can do two things with it. It can cancel or retire the shares, or it can hold them for reissue. When they are held for reissue, they will show up as a negative figure for treasury stock, but when they are cancelled or retired, they are just recorded as a reduction in retained earnings. Finally, we have Nike's total shareholder equity, which is 14.004 billion. It's important to understand equity because it is used to calculate ratios such as return on equity and debt to equity, but we'll cover these in later videos. Let's summarize. Equity can be found on the balance sheet. You can think of equity in two ways. The first is that equity is a way to pay for assets. It's the money that has been contributed by the owners or shareholders. The second way is that equity is what owners can take out of the business. The two main types of equity you'll find on the balance sheet are paid-in capital and retained earnings. Paid-in capital is the money shareholders have paid into the company in return for shares. Retained earnings are the profits the company has kept. A company can return equity to shareholders in two ways. It can pay a dividend, or it can buy back shares. When a company buys back shares but holds them for reissue, they are recorded as treasury stock. If the bought back shares are retired, they instead reduce retained earnings. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com. Treasury